Okay, welcome everybody to another episode of Ridiculous. We finished yesterday with went through Good Times Restaurants. We decided to pass on that. Uh, the idea was that while the brands look to be good, people obviously like them locally in their markets. They're clearly a premium product facing a consumer slowdown, and there's a number of other kind of bips and bobs around the business that just gives you pause to say, okay, it's not a clear double. So why would we be looking at this company? It's just not, you're having to work too hard for it, I guess is the short answer. As always, this is for entertainment and education purposes. This is not investment advice. Do all your own work. We could be wrong. We can make mistakes, and all that stuff. As well, we try to use 100% free tools in all our work on this podcast. And that's so everyone can follow along. You need no specialized tools. Everything's free. You'll see us use Yahoo Finance. You'll see us use, basically anything on the internet, more or less, will get you, help you, point you in the right direction. Okay, so we're continuing with the same screen we had going. And next on the list is the CPI Aerostructures. Keep in mind, most of these companies never even seen or heard before, so we're seeing this all for the first time. They're based in, okay, so contract production of structural aircraft parts for fixed-wing aircraft, helicopters, and commercial defense markets. Reconnaissance pod structures, fuel panel systems, suppliers. Okay, so they make air parts for airplanes and helicopters. Subcontract defense contract. MRO, kidding. Machine gun or window assemblies, hover, infrared. Okay, so it sounds like these are all kind of reasonable products. Yeah, sales and profits have been all right over time. Cash flow more spotty, but you gotta usually check the financials to be sure. And they do have debt, but they appear to have been paying it down over time. So we can already probably tell this is probably not a company we would look at, and the reason is because we don't know any of their products. We don't know any of their end markets. Well, so if you're thinking, should you look at a company like this, right? Well, do you know anything about, any of the products they're actually selling? The simplest way to figure out if you know anything about the products they're selling, name a competitor. If one does not immediately come to mind, you don't. It's that simple. That's the shortest shortcut to get there. Example, if I say Coca-Cola, immediately you can think of a competitor. If I say, engine exhaust manifolds for fighter jets, if you even know what that is, and we don't. If you even know what it is, then you still have to name a competitor. And if you can't name one instantly, you really are not an expert in this area. And that's okay. It doesn't have to be. It's always fun just to quickly check. So pop open the financial statement to see what's actually going on and have a quick look. Or at least you start to get a sense of things, right? So, okay, this company did about $100 million in revenue, right? Not a lot of profit. So yeah, we're just gonna skip it. Don't know it. Doesn't seem like it's, very successful financially from an investor's, from outside third party shareholder standpoint where you get profits, and so we just skip it. No big deal. What do these guys do? Technology software applications. Based where? Headquartered in Israel. Okay. we're going to pass. Mine together. Yeah, generally we look for North American-based companies. The reason for that is we can sort of have a better sense of the company itself, the working culture. Oftentimes they're serving North American markets. And, you sort of have a better sense of the management team too. And that's just generally why we do it. We have a bias towards North America, which is fine. You guys design, develop, marketing, support, implements, and operation of billing customer care systems in Americas, Europe, Israel, Asia Pacific, and Africa. Yeah, so okay. So this one we'll just pass. Also, too, obviously the region is currently experiencing conflict, so you have to take that into consideration. We have zero idea how to get that in, so we don't know how to price in war. So we will just pass. Decision Point Systems Inc. The technology company based in Laguna Hills. Okay. Mobility Enterprise Solutions and Services provides managed and professional services that enable customers to implement and manage complex projects. Designs, deploys, and supports mobile computing systems that enables customers to access employers' data networks. Okay. Mobile computing, wireless, mobile computers, application software, related data capture equipment, barcode scanners, free RFID tags. Okay. It's possible we'll be able to understand what these guys do. Well, they've been growing very strongly. 2019 revenue 40 million, TTM 100 million. So that's a good sign. Profits have been keeping pace, also a good sign. Yeah. Okay. Let's look at the balance sheet. Balance sheet's not too doesn't have a lot of extra room, but it's not terrible in bad shape. Okay. All right. Well, they're reporting their third quarter earnings next week, so you definitely want to wait for those, but let's look and just take a peek at what they've done the last little bit. All right, Decision Point. Provides direct store delivery solution to the wholesale distribution market, so warehouses, we assume. Proof via our proof of delivery and route accounting applications. Okay. So delivery solutions for delivery drivers. Let's first. Sometimes the companies try to like make it so complicated just to understand like what do you actually sell? Barcode scanners, identification supplies, RFID tags, services, solutions, voice solutions, mobile, VisiTrace. Allows you to quickly deploy RFID solutions, pre-built interface multiplications, and high configurable software. So they have a software, enhanced inventory management, visibility, and dependability across various industries. So RFID for inventory. Okay. Okay. Mobile Conductor. What's this? Mobile Conductor delivery management software. One solution for efficiency, productivity, and cost savings. Places paper process with a mobile solution that gives your business real-time visibility into deliveries, inventory, and customer engagements. You can reduce the cost of in-cab technology by enabling all functionality your drivers need on one device to optimize the workflows. Okay. So basically, okay, so it looks like the food industry, broadline, bakery, dairy, snacks. It's just an example. Okay. Well, despite looking like a well-growing software company, trading at a relative to other software companies reasonable valuation. This would take us a lot of work to get underneath. Don't know who any of their competitors are. Like we kind of get the value, but it's not, it's not super clear as to how this product versus another product will win and why. Obviously, they're selling, but businesses move, right? So they're selling, but competitors are developing new products. So you also got to think about the maintenance efforts if you buy something. Just buying something at a point in time, you do all this work, but then how do you going to maintain that level of knowledge in the company, right? Because over time, products are going to change, customers' needs are going to change. How do you manage that without an enormous amount of work? Something like this probably going to be an enormous amount of work, which we would just pass. Like, again, I hate to keep using Coca-Cola as an example, but Coca-Cola, you can get what they do, and the value of those products you can easily yourself test for $2 in the store, right? Coca-Cola puts out a new product, and you really want to get a sense of what that is, just go to the store and buy one. It's easy. Order online, order a case of it, give it to your friends, right? 20, $30. How are you going to easily test or examine the value of a new, mobile conductor or whatever software that helps manage RFID tags or whatever in their warehouse? It just becomes very difficult. And if that's one company. If you have a bunch of these little companies that you have to sort of keep up to date on, then quickly you lose. It's going to require you lose a lot of leverage. Is the short answer. Now, through that process, you will get smarter. If you actually put in the work to get underneath the business or an industry, you will get a lot smarter, and that knowledge will compound over time. The question is it better to spread your chips around or do you focus? Should we look at the next restaurant company, which we feel confident we can analyze well and quickly and accurately, or one of these types of software companies? That's a question you got to answer for yourself. There's no way we can tell you what to do on that. It's just a matter of deciding whether or not how you want to run your operation. For us, we think that laziness is an advantage. That the easier the decision, the better the result, typically. If you think of your best investments, were they the ones you really had to dig and think and calculate and stress, or was the ones like, yeah, this is obvious, this is definitely going to go up? Probably it's the latter, because you were more certain of the outcomes, right? Okay, so we're just going to take a look at the financials because we are curious. Yeah, doing about 100 million of this stuff, which is a lot. Not much in the way of profit, but sell a lot of software. It's mostly hardware and software. They don't break out the two, at least not here. Increase in sales primarily driven by significant equipment orders by two of our large enterprise customers, contributing an increase of 23 million sales for this year and 8.9 increase in overall net sales. So most of the growth is driven by the two biggest customers, and most of it's going to be equipment, so i.e. hardware, not software, which is why profit didn't go up that much. Right, profit went from 1.4 million to, or even if you look at here, profit went up by whatever 7 million, but ultimately it went up by $1.5 million on the bottom line. And even as they cut marketing expense, or sorry, as a proportion of revenue, right? So they did not keep pace with the revenue and marketing expense. Looks like a relatively clean balance sheet. which you would expect otherwise from a software company, software and hardware, but you always expect that. Good though. Without calculating it, if you look at how much is coming from working capital, is that 2, 3.6, 5.7, call it 7.7, almost 8. Yeah, and then accounts payable. So they produced 12 million, mostly coming from, well, net income and depreciation, but also a good amount coming from deferred revenue. Yeah. We're going to pass on account of the fact that we doubt we could, not that we doubt we could understand the business, but it seems like it would be a lot of effort based on our experience to actually maintain that level of knowledge. And so we will stick with something where we get leverage on our existing knowledge. Pyxis Tankers, we're going to guess shipping. Guess midstream, based in Greece. Nope. Yep. Transport refined products, naphtha, gasoline, jet fuel, kerosene, diesel. We wonder, and this is obviously controversial to say or think about, but if you're in the jet fuel, kerosene, diesel, fuel oil transportation business, we wonder what the effect that increase the amount of wars would be influencing this. Unfortunately and sadly, the war machine requires oil and jet fuel and all that kind of stuff. Not sure much of an influence or impact that would actually have, but we'd be curious to know if there's a way to figure that out. Just out of sheer curiosity. Comstock Holdings companies. $40 million market cap. Real estate diversified. See, we can understand real estate. Comstock operates as a real estate asset manager of mixed-use and transit-oriented properties in DC. Company acquires properties, sells residential, commercial, mixed-use properties, and provides a suite of asset management, property management, development, and construction management, other real estate services to its asset-owning clients. Composed primarily of institutional real estate holders, high net worth family offices, and government bodies with surplus real estate holdings. Okay. This is a business we can understand. They're able to grow the business every year. That's good. They are profitable. That's good. Yeah. Okay. Real estate, typically debt might be a problem, but looks like this company is more of a service provider. They don't have a lot of debt. Comstock Holdings Company. Okay. Stock Nope. Comstock companies. Developing, managing, and investing in real estate. They do mixed-use development, real estate services, acquisitions, investments, and neighborhood curating. What is neighborhood curating? Develop high-quality sale, mixed-use transfer. So it's more development work, but very interesting. Properties, office, residential, retail, parking, hotel. Okay. Seems like they might also have holdings of property as well. Let's look at the reports. We can't even fathom what people did before having the internet with this kind of information readily available. That would be so time consuming. Okay. Let's look at the quarter. Sheet. You got cash, assign receivables to related parties. So right away, you know, you got a big related party. Curious to know who that is. You got investments in real estate ventures. So they got some maybe joint ventures or some investments that might not filter into the income statement necessarily. Real estate companies tend to be more finance companies, so you want to look at the balance sheet first. Revenue is up, income is down. Loss on ventures on okay. Looks like share counts are going up. Okay. 6 months. Okay, so mostly accruals. Cash flow statement is pretty clean. Okay, so recent results. Since 1985, so they've been around for long. Acquired, so they've been around for a long time. So what does that tell you as an investor? What is their market cap? Okay, here you go. $40 million market cap. What has the chart done? Well, it's doubled in the last 5 years. That's good. Okay, it's down considerably. I guess this is the financial crisis. And the company has been basically more or less dead money. 14. There we go. $14 2013, 18. So down. It's basically flatlined. Let's see. So you have these spikes. Okay, so you have extreme upside volatility at different points. 2010, 2013. Guess there's a share split. And then after that, it's basically flat. So, remember, they've been doing business since 1985. 1985. That's essentially 40 years. The company is currently at a $40 million market cap. So, and they've acquired, developed, and operated and sold millions of square feet of properties for their own account and for institutional. Right. Okay. So this line alone, right? You've been looking at this for 2 seconds. This line says, in the last 40 years, we've done all this stuff, and their company is $40 million. They have $31 million in revenue, $16 million in income. But the company is only valued at 40 million. So one of two things. One, we might be missing something. Two, something's dreadfully wrong. Three, this might not be a company that has the ability, like, this, it's not growing, right? Like, they're just not growing. It's been 40 years, and revenue in 2021, 22 was 40 million. 40 years. That's not to suggest it's bad, right? Like, not at all. It's just to say that if you're looking as an investor for growing companies, this is done in 40 years, not that much, arguably, in terms of growth for the investor. I mean, doesn't mean it can't, but something to think about. Okay, what is Continued growth of asset management related fee-based revenue? Okay, so they off 1.6. Okay, so they're managing 47 properties, $39 million in revenue, 2.2 million square feet, 1,700 multifamily units. Our company and Anchor portfolio ownership. Derived from the Anchor portfolio. Brought in Dwight Schar as a significant shareholder. Mr. Schar is the recently retired founder, CEO, and chairman of NVR. That, I believe, is the home builder NVR, if we are not mistaken. Yes. Interesting. Okay, so this Anchor portfolio is something that's meaningful that we don't know about yet. Amend and restate the Anchor portfolio asset management agreement extending the term through 2035, adding significant additional revenue streams, including asset management fees, carried interest. We significantly deleverage our balance sheet through the redemption of our Series C preferred stock at a substantial discount to redemption value. Paid off to full outstanding balance of revolver. An exposure to rising interest rates while trading the 10 million. So, okay. We continue development and construction of phase 2 of Reston Station, a 1.5 million square foot addition known as Reston Row. Secured lease for the majority of retail space. EBIT house. Okay, so it looks like a entertainment and space or complex. Finalize the vesture of Comstock Environmental Services business. Okay, so this 16 million, they had $11 million, and a one-time tax benefit 2021. Net income 2022 is 7.7 million. Okay. What is this Anchor talking about? Okay. Two significant transactions. First one, an entity owned by the CEO redeemed all outstanding Series C preferred stock at a significant discount to carrying value. Okay. Secondly, executed a new asset management agreement with Comstock Partners and to control by CEO and wholly owned by CEO and certain family members, which covers our anchor portfolio of assets. 2022 AMA. Okay. 2022 AMA increased the base fees we collect, expanded the service that qualify for additional supplement. Introducing mark-to-market incentive fee based on the inputted profit of anchor portfolio assets. So there's some related party stuff going on. And the CEO looks like it won't let me search for the word anchor. Crazy. It's open. Okay. All right, the old-fashioned way. Most of it's parking. A lot of it's parking in terms of our assets they manage. Fine. In addition, in our development pipeline, we have 16 commercial assets that represent 2.3 million square feet, approximately 3,100 residential units that represent approximately 3.2 million square feet, and 2 hotel assets that will include approximately 380 keys. At full build-out, our managed portfolio of assets will total 57 properties, representing 10 million square feet. Okay. Reston Station. It's a big development complex. Fine. Other assets. So this is the anchor portfolio. Reston Station. Loudon Station. All these stations. Yeah, so it looks like they're providing, it looks like a service provider. Long-term contract with this anchor portfolio, which I guess is owned by the CEO. Here we go. Asset management, 26 million. Property management, 9 million. Parking management, 3 million. Got it. So it's all services, which is great. We are going to look. We're looking at Seeking Alpha, seeing if anyone has actually published on it recently. Lots of buys. Lots of buys. Looks like they did something in the past around home building. This actually looks pretty good on the surface. This actually looks pretty good on the surface. Okay, so they're providing services, real estate services. CEO is obviously backing the company and is an owner and owns some of the assets. So as long as that guy's there, you're good. You're gonna get those deals, which means there's revenue consistency. So they have an actual account. No debt. Basically. My share count is going up. Their credit facility paid off there. So what are they going to do with the money? Something like this. First question should be, how do you as an investor win? Right? How do you get money out? They don't pay dividends. Share count's going up, so they're not buying back stock. So, and it's still kind of centered on commercial real estate. So, and they don't own the real estate, right? It's just service provider. It's fine. You should get more stability, but you don't necessarily have the upside. So we like that they paid off their sort of liabilities and they have cash on the books to $10 million. All these leases and whatever, like fine, it's just operating stuff, kind of working capital. So that 9 million, on a market cap of 40 million, that's meaningful. The question is, how do you as an investor realization, right? You want to have a lot of ways to win if you can. Dividends, share buybacks, growth in the business. You're waiting for the multiple to correct alone. If that's the only source of value, it's a tough game. It's a tough game. Superior Title Services, retail insurance clients. A $10 million revolver. March 25th expiration. So they got lots of liquidity. Lots of liquidity. Okay, I think this looks like we're gonna have to take a look. Comstock. CHI, CHCI. Okay. So the primary questions would be, what are the primary questions? So the relationship, CEO. I see some stuff going on there where CEO's getting some related party transactions. So doesn't mean there's anything wrong with that. Just gotta, you gotta make sure you're get a full grasp of what those look like, so that you as a shareholder, as a minority shareholder, are not being disadvantaged. It can happen. So relationship with CEO, the prospective growth trend. They said is that they got this huge development pipeline. How much is that development pipeline going to add to income, and in what time frame? As those buildings come online, if they're already under development, someone has to manage them. And if the company is supporting development efforts, then the chances are they get those management contracts, particularly if they have this related party relationship with the CEO and he's part of it. And the third one, big one, at least immediately, would be capital allocation. Investors, shareholders, get out, slash win. But dividends, or share buybacks. In fact, there's share issuance, which you got to look at. The Class A, Class B stock. Okay, so Class A, 1 vote per share. Class B, 15 votes per share. So dual class share structure, presumably. They're economically, so that's a good thing. That's a good sign. Shares of Class B are convertible to an equivalent number of shares of our Class A stock upon transfer. So that means that you have economic equivalence to the Class B, even if you don't have voting equivalence. Similar structure is in place at Berkshire. Other companies like that. So usually these kind of structures allow owner, founder, whatever, to maintain control, but doesn't disadvantage the public shareholders from the perspective of economics. So that's a good sign, right? It's if they did or at least it's not a bad sign necessarily, right? If you already know you already know that the owner is in control or the CEO is in control, right? He's a major shareholder, all that jazz, right? I see. Okay. So they issued stock of 1 million for the Class A shares. For the redemption of the Series C preferreds, they did $1 million issuance of common stock, million shares of Class A, valued at the consolidated closing bid price for the Class A on Nasdaq immediately prior to the entry into the deal, and 4 million in cash, and 4 million in cash. Oh wow, okay. Total carrying value of the Series C preferreds was 10 million. So the difference between the share exchange was counted for as a redemption. Therefore, the 2 million difference between the carrying value and the 8.3 million or fair value of the consideration upon redemption was added to net income to arrive at income available. Okay, so this was in June 2023. So, sorry, June 2022. So in 2022, they had an addition to income. Here it is. Impact of Series C preferred stock, $2 million. Yep, above board, very clear and transparent. The question is this $1 million stock, this $1 million shares. So the guy had $10 million in prefs. The prefs, by the way, appear to be owned, or believe were owned by the CEO. Okay. Only do a search. Okay. I believe it was owned by the CEO. Yeah, so here, so first one was CP Real Estate Services LC, which is owned by the CEO. Right, so basically the CEO had 10 million in preferreds. And let's see. Okay, here's the share exchange agreement itself, right? Right, June. Okay. So he redeems 10 million, gets $4 million in cash. $4 million in cash, $1 million in stock. Therefore, the CEO himself has valued the shares in June at $6.30, which is about 50% higher than where it's trading today. Right? Because he had a $10 million preferred. Yeah. Got 4 million. Or was it 10.3? Or was it 6? Where's the yeah, 10.3. Carrying value was 10.3 million. So $10.3 million preferred. Got 4 million cash and $1 million in Class A stock, but he valued it at so that's yeah, we're not loving that. See how he did that? See what happened there? So the suggestion is that the CEO believes that the stock is worth at least $6.30, right? 4 million cash minus 10 million, 6.3 million, you got 1 million shares, $6.30 a share. But he received 1 million shares. We're thinking about this wrong. Are we thinking about this wrong? Are we thinking about this wrong? Doesn't matter what the current share price is. Doesn't matter what the current share price is. Let's think carefully through this, but it might not. Think about it this way, because it's a fixed number of shares versus a dollar amount to be translated into shares. That would be the thing where it would be okay, there we go. So okay, so this looks okay. This looks legitimate. This looks like a decent deal, or not a decent deal, but at least we don't think that it's disadvantaged minority shareholders, right? Like for example, if you said, okay, rather than setting a fixed number of shares for the remaining dollar amount, imagine if it was like, okay, give me 4 million in cash, and then the remaining value translated into whatever the shares are at the current price. So it appears that probably at the time, I guess shares might have been trading for 4.3, so $4.30, presumably. Let's go back 1 year to June 2020. Oh, for goodness sakes, June. Yeah. Call it $4.30, which makes sense because the fair value of the exchange was 8.3. We got 4 million cash, million shares, $4. It's okay. So imagine if rather than doing a fixed number of shares, he said, okay, $6.3 million at $4.30 current price. Give me that in shares. That'd be 1.465 million in shares. See what I'm saying? So basically, rather than fixing the dollar amount he's owed, he fixed the number of shares. As a result, the implication of that is that the CEO believes that the stock is worth at least $6.30, if not more. At a minimum, if not more. Guy like this, you know, we don't see him just giving away $2 million. Just would be, yeah, we don't think that's even, we don't think that's a sensible possibility. Anything's possible. We just don't, that would not be our default assumption. So, yeah. So that's good. Hmm. Okay. Okay. So all right. Let's uh let's look some more. We'll read through this agreement a little bit later. So what is going to drive growth? How should we think about the value and what will drive value? Services provide cover all aspects of real estate asset management, including acquisition and disposition management, leasing, design, placemaking, property management, origination, negotiation of debt and equity facilities, risk management, construction, development management, creation of investment opportunities, execution of core plus, value add, value add. That's a service. All right, cool. Value add. Opportunistic strategies and various other property specific services. What value add is not a property specific service? What service do you provide? We add value. We're a value add service. Okay. Okay. We have contracts, property management contracts with each. 87% leased, 89% leased. Okay. So they have 16 properties in addition. Okay. So in the growth category, it's 16 properties or new properties of development pipeline. When do those come online? Online. Will they be done? Reston Station. It covers composed of 5 districts. Reston Station. Oh, there's a whole website devoted to this. Jesus. Okay. There's an entire website devoted to this complex. In Washington. Reston Station. Okay. Luxury residential tower, 448 units. Restaurant Road District. Currently being developed. 9 acres. Okay. Currently leasing and managing 4 existing office building. All filings planned for new development. Okay. Also, Ludum Station. Direct rail connectivity to Dulles International. $1,500 space metric community parking garage is subject to partnership. At full build, the Ludum Station development will cover nearly 50 acres. Investors X. CPRES is the CEO's company. So on April 30th, 2019, we entered a master transfer agreement with CPRES that provided for priority distribution of residual cash flow from its Class B membership interest in Comstock Investors XLC, an unconsolidated variable interest entity that owns Comstock's residual home building operations. As of December, the residual cash flow relates to anticipated proceeds from the sale of rezoned residential lots and return of cash securing outstanding letters of credit, cash collateral posted for land development bonds covering work performed by subsidiaries owned by Investors X, cash released to CHI as bond release work associated with projects completed. Okay. So that's it. X. How much is that worth? The clue here is that they said it's an unconsolidated entity. So if it's unconsolidated, means you're not going to see it in the financial statements. So how much it's worth is something you gotta consider, right? Now, this is saying that the CEO is getting a priority residual distribution, so he gets paid out first. This is their this is their they own their residual home building off. So I guess they used to be a home builder, and now they don't do that at Comstock. So they're selling off rezoned residential lots and returning cash. Yeah, so basically selling off. They basically have remaining assets. They're just selling it off, and they're getting cash that they posted for letters of credit, for land available bonds. So selling off lots and getting returns of cash for letters of credit and bonds and bonding. The CEO gets cash first Class B membership interest, and the rest is going to get released to CHI. The question is how much. It's not clear from this how much they're going to get. And if it's not consolidated, then you might not see it. They might not have a note in the financials. Who knows? Okay. We entered into a joint venture with CP to acquire a stabilized building immediately adjacent to Clarendon Station Metro. Okay. Premier Transit Office, Roslyn. In February 2020, we arranged for Divco West, an affiliated entity, to purchase a majority interest in the building and secured an $87 million loan from MetLife. As part of the transaction, we entered asset management. So they entered into a JV with CP to acquire it. So how much money is in the JV from them, from Comstock? Investments in real estate ventures. Is that this? $6 million bucks? Don't know. So JV. We assume CP is CP Rail, but I guess perhaps not. It just says CP. CP who? Who's CP? Okay. Another building, they own 5% equity interest. Also 5% equity interest, another building. They got acquisition fee, they get investment income, and distributions. Let's get property management fees. Okay. What is their unique business strategy? Probably is to generate cash flow. Yeah. Mixed-use, transit-oriented assets in high-growth, high-potential areas. Section on transitioning, suburban, nice, markets. These suburban submarkets include Dulles Corridor and the Rosenbals Corridor, experience increasing demand resulting from flight to quality, which we believe will continue to drive commercial tenants' demand for the type of development. Right. Okay. We believe residential tenant demand will follow a similar trend, increasing the population willing to pay premium rents for high-quality residential units in neighborhoods that are transit-oriented. A significant portion of our portfolio of assets are located in these sought-after areas that are also feature strong projected long-term economic growth supported by attractive demographic attributes. So they're basically saying they want to manage properties in good areas that have transit capabilities and are not in a downtown core. Okay. Significant growth trends in demand for cybersecurity and other technologies from government, as well as generating substantial growth. Large technologies of Microsoft, Dell's Core, and Verizon. These areas are home to significant data infrastructure capable of serving growing needs technology company federal government. Specifically, is that with its vast networks of high-capacity data centers, Dell's Core and Luton reportedly host upwards of 70% of the world's internet traffic. That has become known as the internet capital of the world. Okay. In Northern Virginia. Which is Washington, basically. Yeah, okay. So they're kind of saying technology companies are spending money here, and they have a huge amount of infrastructure there that's not going to move, which is good. That is a good thing. Leveraging our expertise to secure public-private partnerships and development opportunities. We work closely with our affiliates to secure public-private partnerships with multiple local governments, including Fairfax County, Loudoun County, and the town of Herndon, Virginia, to develop and manage large-scale mixed-use transit-oriented developments. Our knowledge and long track record of developing and managing first-in-class properties across the region position cause as attractive partner for managers looking to develop. Okay. Recent changes in the comprehensive land use plans of Fairfax and Loudoun County to encourage high-density mixed-use development proximate to the Silver Line metro stations may further result in compelling growth opportunities. Recent changes to the comprehensive land use plans. What are these recent changes? What are these recent changes in Fairfax and Loudoun County? Page 5. Okay. Actively growing our supplemental real estate services and exploring investment opportunities. We provide a variety of fee-based real estate services such as capital markets, brokerage, title, and insurance. Okay. Providing these supplemental services serves as a catalyst for identifying additional strategic real estate opportunities. So if we do this stuff, we might be able to find investments. We seek out opportunities that can provide appropriate risk-adjusted returns that are suitable for co-investment, potentially with institutional investors that may lack the local expertise or operational infrastructure necessary to identify, acquire, and manage such assets. Our acquisition strategies currently focus on value add, core, and core plus opportunities, as well as other opportunistic. Okay. It looks like in addition to 60 development properties, they're looking for more investment in JV opportunities. Okay. Hmm. 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 Yep. Seems positive. Okay, environmental, ESG, great. Okay, good. They're using new concrete. Fine. It's great. Also great. Competition. Fine. It's a competitive industry. This guy's licensed his Comstock brand and trademark to us in perpetuity. Okay. Currently, substantially all of Mr. Clement's real estate development business is conducted with Comstock pursuant to the 2022 AMA. This is obviously a key document, which you'd have to. Relocated their new lease. Okay. To Reston Plaza. Good. 10-year term. From an affiliate partially owned by our chief executive officer. Okay. Execute a lease for a remote monitoring center for Park X. And execute a lease to expand our corporate headquarters, bring the total amount of lease space to 25,000 square feet. Okay. So you're heavy betting on this guy, this guy Clement. Um, he's obviously a central figure, core player. Now, some people think that's a bad thing, right? He's obviously got the power, um, and some people think, well, there's no change that can be made. By the way, we're going to sign off right about now. We think this is looking worthy of further study. It's a business we can get. Demand, it's a service provider, real estate properties. Fine, we get it. And doesn't look overly expensive. So yeah, people, this guy Clement, he's obviously in charge, and you're tied to him at the hip. Is that a good or bad thing? The answer is you don't know, right? Like Warren Buffett controls Berkshire Hathaway for all intents and purposes, and that's been a very good thing. There's other companies that we will not name where the CEO controls it, and that's a very bad thing, or at least it's been disadvantageous to minority shareholders. The fact that a single owner, a single person, uh, is in control, and you can clearly identify who that person is, we think that that aspect, the identification of that, is a good thing for shareholders. Then you can say this person's running the show. Now that you know who's running the show, uh, let's look at what he's doing, right? So far, the CEO has had opportunities to uh, direct, value towards himself at various in a couple deals that we looked at, and it's all been arguably above board, right? It's all been, uh, you know, I'm not gonna say, it looks like it's all been done on fair business terms, right? He has, or at least he has not. It doesn't appear to that he has disadvantaged minority shareholders, and that's a good thing. It's like he's conducting business above board. Um, he's obviously in control. The company's obviously dependent upon him. You have but he has this long-term contract where the company has management rights, property management deal with him until 2035. So he's fully committed, right? He had this pref share redemption where he could have secured the value, but instead he secured the number of share units, clearly indicating that he feels the value of the company is much, much higher, and he's willing to take that bet, right? Um, so, you know, we think that on the surface, it, of course, bears very critical study. It's 2220. I mean, you got to read it in full detail. You got to see what's going on. But so far, from the deals we have seen this guy's made with the company, it looks like he's done right by the company, or at the very least, he has not done wrong by the company. He's dealt with the company fairly, and so you as a minority shareholder, that's a good thing. Doesn't mean we'll be there forever. You always got to keep an eye out now, but again, because you can point to the person who's in charge, that is an advantage. And that's the key you got to focus on. It's not the fact that someone is in control. It's, can you identify who's in control? If the answer is yes, are they beneficial to you as a shareholder? In many situations, they're not. So you just walk away, right? In many situations, the person with the power is going to enrich themselves at your expense. Walk away. But if the person who's in charge, who's got the power uh, to direct the value, as long as they're not disadvantaging you, in fact, as long as they're treating you as a reasonable, silent minority partner effectively, then fine. Then you don't have to worry about that as a consideration. As long, then all the other considerations, are they good at their job, building value, blah blah blah. But you can remove as a risk the fact that they're going to screw you over. Okay, well, this was good. We think this was productive. It's always exciting to find something that looks interesting, even though 9 times out of 10 it ends up being a no. It's at least steps in the right direction. Thanks for joining. See you next time. Bye.